Aloha. Thank you for being here this morning. Today's Economic Forum brings together industry leaders, including Realtor members, policymakers, and members of the business community for a timely discussion on Hawaii's housing and economic outlook. Thank you for making the font large enough that I didn't need my reading glasses. We're honored to have Dr. Lawrence Yun, Chief Economist of the National Association of REALTORS, as well as our local government and elected officials in attendance, who play a critical role in shaping policies that impact our housing landscape. I want to say, for those who go to the national stuff and you see Lawrence speak, he's normally in like huge auditoriums and people are clamoring to get in there. He's like a rock star. And we wouldn't have got him if not for our tenacious, the word could be nagging, CEO who was like, "Oh, Lawrence, you got to come to Hawaii." And he's like, "Oh, they're never going to approve that." He goes, "Oh yeah, let's go see Nakia." So we walk to the top of the stage, and there's Nakia Wright, our CEO, just got off, just, "Nakia, Lawrence needs to come to Hawaii." And she's like, "Make that happen, make that happen." And the reason is, earlier that day, we had dumped all our remaining chocolate macadamia nuts at Nakia's desk. And so she knows how to grease the wheels, and ultimately $20 of chocolate macadamias got us Lawrence Yun to speak to us today. Okay, I'd like to also recognize our partners UHERO and DBED for providing supporting data, as well as our generous sponsor, Bank of Hawaii, who has made today possible. Your support ensures we can bring these important conversations to life. Our goal today is simple: to share data, provide context, and have a conversation about the opportunities and challenges that exist in Hawaii's real estate market. We're here to collaborate and learn from each other. The people in this room, from policymakers to business leaders to realtors, are all essential to this conversation. We share a common commitment to find housing solutions to help our community thrive. Realtors in particular are on the front lines every day of this effort. As housing experts, we help put people in homes and build futures here in Hawaii. Today's forum is an opportunity for our members to engage, ask questions, and gain insights from Dr. Yun, the Honolulu Office of Economic Revitalization, and the Department of Hawaiian Homelands, who bring both local and national perspectives to this topic. We hope you'll take the insights you gain today and apply them in your daily work to better serve clients and our communities. By working together, we can identify opportunities and develop solutions that make a lasting difference for Hawaii's housing future. So mahalo for being part of this important discussion. This morning, we'll hear from our city's Office of Economic Revitalization, as well as the Department of Hawaiian Homelands. In our second half, I'll provide a Honolulu market update and perspectives, and then our keynote presentation with Dr. Lawrence Yun on national trends. So without further ado, I'd like to introduce our first speaker, Deborah Zeisman, Deputy Director with the city's city's Office of Economic Revitalization, which was established in 2020. She'll provide an update on what their office has been focusing on, as well as an update from the city's Department of Housing and Land Management. Let's welcome Deb to the stage.
Good morning. It is an absolute pleasure to be here on behalf of the City and County of Honolulu administration. So I represent Mayor Blangiardi and my boss, Mike Formby, who's down here. I told Mike, if you have any difficult questions today, I'm going to make him take the mic and take over. So my name's Deborah Zeisman. I'm the Deputy Director of the Office of Economic Revitalization. So I am not with the Department of Housing, so I'm just going to put that out to begin with. We will go into a little bit of a housing overview today, but I will potentially have to take back any questions that you have, and I'm happy to come back to Suzanne with and answer questions that you've got. So, okay. And I love that in the back there is a Pikachu and a Super Mario. It's going to be quite distracting for me up here. So, okay, the Office of Economic Revitalization, we are on a mission to ensure that everyone in our city and county, that every person prospers. For that, we are trying to improve quality of life for small businesses, for every family, for every person. It is broad. So we are looking at that economic vitality, cost of living, to make sure that, I was chatting earlier with folks, that our kids can stay here. Right? How can people make it in this community and stay and live as we do? We know we are in a challenging time. I think, especially with some federal things, it's getting even more challenging right now for our community. We have a high percentage of households that are cost burdened, right? They are paying a large percentage of their family income on housing. It's been going up. We have been seeing out-migration, as some of us were chatting about earlier. We are seeing more and more of our working age people in this state and on this county leave. They are going to places that are cheaper, where they can realize the American dream, where their income might stretch further. And it's particularly happening among some of our younger workers and among that middle income folks. We are seeing the barbell effect. You've probably heard this before, that missing middle, who are likely your home buyers, right? So we are seeing very few at the very top who are extremely wealthy, a growing number of folks who are in the bottom and are living paycheck to paycheck and just getting by, trying to figure out how to put food on their table, and really a thinning of that middle American, the folks who want to get into the starter home, want to upgrade to the next house. That's where we're seeing more folks saying that they are just concerned that they cannot make it in this community and they might need to move somewhere else. That's concerning. I just saw some new survey data that shows it's perhaps even rising, of folks saying, I think I'd love to stay here. This is where my family is. This is my community. And I might just not be able to make it anymore. And we know that Hawaii has long struggled with housing supply constraints. You all know that better than I do, that we have limited developable land, right? We have high construction costs. We have limited supplies. So how are we going to address that? So at the Office of Economic Revitalization, we believe that a strong economy is about the quality of life. We are grounded in what the people that we need, that we serve in this community. We are focused really heavily in 3 areas at my office. So one is creating good jobs. How do we have jobs that will pay the rent or pay the mortgage and put food on the table? We also believe strongly that what we need is resilient small businesses. Small businesses being the bread and butter of an economy, right? The local mom and pop, the startup, the entrepreneurs, regardless of sector, what can we do as a community to build and help our local small businesses to thrive? And we are also looking at access to healthy local foods. Our office talks a lot around how this place that we live in has historically been a place of abundance, right? If you go way back, this place fed and clothed and housed a large population with nothing coming in from the outside for quite a long time, right? We fed ourselves, we housed ourselves. And now we know we bring in an overwhelming amount of our food, and it's often very high priced. We have to bring in building supplies. We have to import everything. And how can we start to push back and move to a place reclaiming that abundance and self-sufficiency, that we are not a little bit less dependent on bringing in the very overpriced gallons of milk that I go through every week because I have 2 teenagers at my house, right? How do we get back to that place of a more circular economy of abundance? And so I think, right, that we feel like we are thriving and taking care of our neighbors and our own community. And a piece of that is food. Our work as well at the city and county right now is truly about listening to community. I think many of us have experienced throughout time that sometimes government just does things, sometimes, without necessarily people say, where did they come up with that? And I think this administration is really committed to being out in community and listening to real people all over the state. About most of my staff is out in community every day, talking to families, to small business owners, to farmers. I hope they're talking to some realtors as well and saying, what do you need of our city government? And trying to fill those needs. So actually listening. And I think this administration is making some of those process changes across I hope you're seeing some of them, right? Listening, saying, how do we make sure that the line at the DMV is going quicker? Can we do that? How can we improve our permitting system and trying some new things? My office is saying, how can we make sure that people can access healthy local food near where they work, near where they're going to school? So listening. I'm not going to go into this piece, but if you want to read, we have a county comprehensive economic development strategy that goes really in depth. A lot of people in the community put it together. It's online. You can find the comprehensive economic development strategy. But I want to highlight a few things that we are doing at the city. So one, on small business growth. We have just graduated our very first class of what we have called Idea to Biz, which is helping those local entrepreneurs to start up a business. Literally going from an idea to developing a business plan, to getting connected with a business banker, to securing some startup funding. So we have a number of incubators that have been existing in the state for a while. They're often at the stage of helping folks to scale, right? So to take it to the next level, develop markets outside of our state. We're trying to get in more at the ground level. So our first group, we graduated 15 folks in Nanakuli. So how are we helping real people that have an idea? One person wanted to start a bookkeeping business. Another is starting a roll-off dumpster business. Someone else is starting an Aloha Shirts. So we're talking the small, on the ground, but again, trying to think, how are we helping people to move to that next level, to take a risk, figure out how to navigate things like all the paperwork that we have sometimes, get them connected to a bank. Some of these folks might be considered unbankable. And so the list on the slide is our community partners that we've worked with. So this was our very first pilot. We are planning to replicate it in 2026. So doing more of this small business incubation, particularly in places that perhaps you would not expect, right? How do we help some of the new immigrant populations start their first business? Folks like our group that we had in Nanakuli. For our very first cohort, we had over 180 applicants to join that program. So there is clearly demand. We know that folks are trying to improve the lives of their families, and I think the city is thinking, how can we help? What can we do to help them connect, to figure it out, to get moving on that piece? Our second focus is on good jobs. So we have been doing quite a bit of work using some of the federal relief funding from COVID on good jobs with UH Manoa, with HCC, LCC. So doing job skill training, looking ahead, using some data that we have as to where the next jobs are. I think that's the place we're looking. What is the job market of the future that we need to be filling, and what are good jobs? So we want to move our county towards more jobs that, again, can feed a family, that are sustaining jobs, right? That can help folks to buy that first starter home, to put food on their table. We know historically in this last era, we have had a lot of service industry jobs, right? They're often low paying. So we are looking at things in this next year, like how are we having more jobs? What's the impact of AI? We'll be doing some things in 2026. Also things like advanced manufacturing. Like what can we be doing, again, for that local sustainability in our own community. So jobs of the future, how are we building and supporting those jobs that we know our kids that are coming out of college will need? And I'm sorry, one other thing is apprenticeship models. So apprenticeships, we have some that are starting up, but the county is looking to do more, both whether it's construction industry, education, but again, that apprenticeship, where you have a paid apprenticeship and you're moving along a career path. And then finally for our office is sustainable agriculture and food systems. So we know in a household you have three major costs. So housing costs, childcare or kupuna care, and then food. And so again, in that idea of growing abundance in our county, we are looking, what can this city do? How can we help folks to access local, healthy food that, produce, proteins, maybe to get them at cheaper costs than having to go to the grocery store. And so we are piloting a number of efforts of how can we help make sure that folks can get food on their table at an affordable price, and again, support our local agriculture community. So we have been piloting a food access at public property. Perhaps some of you have seen it along our new Skyline stations. So we have had farmers markets that we're doing, as well as food bank distributions. And we are also putting in planting and growing along the Skyline Rail, so that you might see at some of the stations, there's ulu trees. And we now have put in herb beds and vegetables, and bringing in folks to do growing at the stations as well. incredibly popular. I think we just piloted. I think that's, again, our office likes to do what we call, small bets. Can we try a thing? Can we pilot it? Can we see how we tweak it? And so in 2026, I think you should look forward to seeing more our skyline and potentially other public properties, the city properties around our island, as places of abundance that have food where you could stop on your way home and pick up either a prepared meal, pick up your produce for the week, pick up your proteins for the week. We're also looking at expanding and innovating with our community gardens, with our People's Open Market in the coming year as well. So again, how can we make sure that we are having food accessible to our community? And the final piece for our office is a focus on regenerative tourism. Again, tourism is an enormous, important industry for our community. We are starting development of an Oahu tourism strategic plan. And in that plan, what we are focusing on is that idea of regeneration and locally driven. How do we make sure, one of the folks in my office likes to say, we don't have a tourism problem. We have a problem that the tourists are in the way when you're trying to get and drop your kid off to school, right? I think we love and want tourists here. It is really on how do we make sure that, the tourist is having a good experience and that the local community is having a good experience. So can we work and nudge some ways for tourism to have better paying jobs, better locally owned businesses that are selling those local products that they are making to tourists, that are running local companies that are taking them out, that is culturally based, that is Aina based. And I think there are many models we can look to around the globe of how folks are doing tourism that feels good to the local community, right? We want it to be a benefit to all of us who live, work, and play here. So we are looking at more things like the destination management that was put in place at Hanauma Bay. Have folks been to Hanauma Bay since we put in place the new destination management? No. It's great. If you haven't been, you should go, right? Because what we've done is using some new advanced computers, have a better experience for tourists because we are now limiting the numbers. We are charging the tourists for that experience and opening it up so that it's also less crowded and more open for the local residents. So I think it's a win-win, right? You're giving a better tourist experience and a better local experience. And then our office is also doing a number of things. We're doing community placemaking. So for example, we have an event coming up on November 15th. I invite you all to join us. That is called Taste the Town in Wahiawa. So getting folks out. Wahiawa has some amazing new things happening in it, has some phenomenal chefs and restaurants, and getting folks out to highlight what's happening in many other parts of our community, both the tourist community as well as the local community. So placemaking, how are we building strong, vibrant places, right? We can talk about housing, but we're talking about all the other, the connective tissue between everything else, right? That makes a place wonderful. And it's things like our Taste the Town Wahiawa, like fun things that highlight the unique nature of our different communities. Woo, Wahiawa. Awesome. It's going to be fun. Alan Wong is going to be doing a cooking demonstration. Come on out. And then a few of our priorities from our office, and then I'm going to jump into housing. So a few things that we're looking at. One is growing that small business incubator piece. So if in different sectors that we're talking about, how do we help more folks start up? We just really feel like that small business market is really critical, and we know it's often tough for folks. If you don't come from a family business that's being handed off to you, tough to get in with a new idea. And then we are also really exploring the use of using city properties for more economic development. The city has a great deal of property, and how can we use it to our advantage? It belongs to all of us, the taxpayers. How can we use it for some of those entrepreneurial startups? How can we use it for childcare? How can we use it for arts and culture? We know we want to have more arts and artisans and musicians and things like that. So to, again, revitalize city properties and think about how to utilize them in new and different ways. Okay, I will now jump into a few housing pieces as well. I need my glasses for this part. So earlier this year, the city did develop a strategic housing plan that the city council adopted, and it has 6 priorities. I highly encourage you to look at the housing plan, or if it takes too much, you can feed it into ChatGPT and it will give you the bullet points. No. So one key piece that we have done is put in place the new Department of Housing and Land Management. So for the first time in 30 years, we have land transactions, development, finance, and policy under a single roof to try to streamline, to bring together those conversations before they've been spread out across the city. And we realized that that was not working. We needed to bring them together to have some more synergy, to have them work hand in hand together. So now this is what we're calling, it's really much more of a conveyor belt and able to help the city move things more quickly. The next is streamlining development on public lands. So we have identified 10 existing city properties in really short order. So quickly those were identified. And we have already put in place a new request for qualifications process. The process before, for any of you who are not aware, was quite slow and cumbersome. So what we did was revamp that process to bring it to a really fast pace compared to what we had before. We are able to quickly partner with private developers, the folks who can build, and scale quickly without having to put that burden on a larger internal city staff. So together, these new sites that we have are representing about 2,500 affordable housing units that are now in process in the pipeline. I hope everyone has seen this already. So this is the Skyline Corridor. So this is our transit-oriented development. We are looking at Skyline as the spine of the body that will feed through our community. And we now have 9 transit-oriented development neighborhood plans that go from East Kapolei down to Ala Moana with extensive community input, which actually continues for the new stations as well. Those plans have now been adopted as policy, and they're providing the framework for density, for infrastructure, and truly to move us towards livable mixed-use communities. We really want to keep residents rooted, reduce commute times, and create livable rail communities. We're seeing that happen at some of the existing stations, and with Segment 2 opening just a couple of weeks ago, we are now seeing increased ridership and since the rail is now all the way to Kalihi. Iwilei is the heart of the Iwilei-Kapalama TOD corridor. We think it will be one of the most transformative zones along the rail line. So in 2024, the city purchased Iwilei Center and the former First Hawaiian Bank, which is adjacent to what will be developed as the Kuvili Station. In early 2025, so earlier this year, the Department of Housing and Land Management issued a request for qualifications for a development partner, and we selected EAH Housing. That core is now, we are looking at a 16 to 17 acre area that will support between 2,000 and 3,000 additional units. I know Suzanne did ask if they're going to be for sale or for rental. I'm gonna have to get back to you. I think I'm looking to Mike, rental mostly? Mostly rental. Mostly rentals we're looking at. Again, the city is focused on what we can do in affordable housing as a top priority. And we have $2 million in Federal Transit Administration TOD a pilot grant funding and $700,000 of state planning grants to move forward on the Iwilei development as well. So huge work ahead. I think enormous potential as well for the realtor community in thinking about the potential with our transit-oriented development and thinking creatively, thinking outside the box, thinking holistically, right? Of what are we doing to make those new neighborhoods that are coming up places for folks to live, to work, to play, they're truly sustainable. Going back to that idea of abundance, I think, right? We're thinking about how can we build, some of them are, I was gonna say, dense and rich. I'm thinking that's the adjective I'm looking at, right? Rich communities that we're building up with culture and with community. But we are working on executing these plans have been in the works for decades, and they are now coming to fruition. I think I look forward to some conversations with you all today, too, because I think the issues our community is facing, as our mayor likes to say, there's some wicked problems, right? We have a high cost of living, high cost of housing. No one of us has all the solutions on our own, and so I think this is an area where partnership with folks like you that are also in community and see the needs. What do we need to do to make sure that housing is affordable, the people, that it can be mobile, that we have a thriving market in this area, strong, resilient communities? We'll need to also have those conversations, and I think we're committed to listening and talking with all of you to find those solutions together. So at the end of the day, again, the city, we are hoping and working towards that every person prospers. All families, all businesses across our community, and we look forward to working with you on that journey. And my email is here, so you can write it down. Message me with any questions you have. You have my commitment that if I don't know the answer, I will find out and get back to you. So thank you all so much. I will be around, and I'm happy to chat.
Thank you so much, Deb. I'm pretty good at identifying problems, so it's nice that somebody in the room can come up with solutions. Next, I'd like to introduce our second speaker, Kalani Franda, who is the acting administrator with the Land Development Division of the Department of Hawaiian Homelands. Kalani will provide an update on the work that DHHL is doing to deliver resilient, affordable housing for its Native Hawaiian beneficiaries. We appreciate the work that DHHL does because every housing unit that's added to the state of Hawaii makes a difference. Please welcome Kalani to our stage.
Aloha kakayaka, good morning. What a beautiful day it is. You know, before I start, let me share with you a olelo no eau, a Hawaiian proverb that grounds me in this work that we do. Iulu no ka lala I ke kumu. The branch grows because of the trunk. It reminds us that every part of what we do, every family we serve, every home we build, every community we shape grows from the same foundation. For the department, for DHHL, that foundation is our mission to return Native Hawaiian beneficiaries to our land. For you, it's the relationships, it's the trust, it's the kuleana that sustains Hawaii's communities. We are all branches of that same tree, nourished by our shared purpose to care for this place and its people. And when those branches grow strong together, just like you heard Deborah mention about providing opportunities and ways to collaborate, incredible things happen. Families find stability, communities take root, futures flourish. Because in the end, this work is not only about construction or contracts, it's about connection. It's about pilina. It's about building relationships. So before we go any further, I want to show you what that connection looks like. What happens when planning turns into purpose, and purpose becomes a home. Heavenly Father, we thank you for this beautiful day that we have here on the island of Maui. We thank you for all of the families that have been blessed by this great opportunity to be connected with the Aina once again.
In the past 2 years, we've moved to 4 different zip codes. In 2 days, our new zip code, for the Lord's sake, will be forever 96793, and we feel so blessed about what's happening to us and what's going on with the Department of Hawaiian Homelands.
Puahona carries a name that reminds us of steadfastness and perseverance. And that is exactly what our homesteaders have shown. Years of patience, hope, and determination. Today, that perseverance is rewarded with the keys to your new home.
The peace now that we have actually being in our home is absolutely overwhelming. And we're just so blessed, and thank you, Jesus, for this wonderful opportunity and for our new home. We're happy to be here.
Pu'uhona is more than homes. It's building a community. It's building a strong community. And it's helping us go back to our roots. Mahalo for your resilience. Mahalo for your patience. But welcome home. Welcome home, Auntie. Welcome home, Uncle.
I like being home. And it's so many years since I left. At nights, I used to have memories of just coming home. And basically, I was thinking about Kahului, where I was born.
At the end of the day, it's about people. It's putting people into homes, making them a part of the community, and making sure that it's for generations to come, right? For many of these families, they'll pass it on, and this will be the home base for many great events, many great milestones in their life. And that's what it's all about. It's making sure that we can make that happen for many beneficiaries.
We're blessed to work with these wonderful people, and they're dedicated. They want to solve the problem, and they want to get Hawaiians back on their land. And when we do these projects, it doesn't just help the beneficiaries, but those beneficiaries and having these houses, that opens up other housing for non-Hawaiians. So these projects benefit the whole community, not just the beneficiaries.
The location is perfect. It's central to everything. My son is in a great school. He just started kindergarten. He's so happy to be in his new school. So we're very, very blessed, and we're very fortunate to be here.
This blessing ceremony is not only about asking for guidance and protection over these houses, but also recognizing the kuleana that comes with homesteading. Together as a community, you will nurture this aina, uplift one another, and create a foundation for generations to come.
93 years young, she's been waiting 38 years for this opportunity, so welcome home. Today we have Director Cully Watson with the keys to your hale.
Very happy to partake in this celebration, but also for the work-wise, you can see, right? Auntie Helen came home. She's 93 years old, got to move back from the continent into her new home today, and she blessed us with allowing her to be on her property today, celebrating in this momentous occasion.
I just want to tell the people of Maui, I'm so happy to be home.
Ooh. It's times like those that we realize why we do what we do. And Auntie Helen was living in Vegas for 30 years with the hope that she could afford something and be able to come back home. And the amazing thing is she was able to qualify for a loan that was only issued out to Hawaiian Homeland's beneficiaries here in Hawaii. It's called NAHASDA, and it's the Native American Housing and Self-Determination Act monies. 1%, 0 down, $700,000 house, 5-bedroom, 3-bath, $1,600 mortgage. Auntie could return home. Auntie could return home. You heard that pule, prayer, guidance, and intention are the heart of this department. Every morning I ask for that wisdom, that clarity to lead with aloha, to bring purpose to every decision, and to add life into every interaction. During a time where economy is interesting, when we look at the positive things, when we count our blessings and we name them one by one, it's those things that we see that there is hope, and we're providing those beneficiaries that type of hope. And so that's why it's critical to have those of you that are really invested into this space. You're connectors between people and place, between opportunity and stability. You help families navigate the market, envision really what they're going through, provide them an opportunity to learn what it's like for home ownership, and to help them turn dreams into legacy. Today I want to guide you through our 4 action-oriented principles that anchor our work and yours. Why? There's an urgency. Hawaii's housing crisis is immediate. And what a great time it is, because many different agencies across the board realize that there is an urgency. And what a great time to be in this space. So how? I'm going to talk about partnerships. We can't do it alone. It really takes a village. What is it that we do? I'm going to share with you progress. It's not just measured in homes, but the lives that we stabilize. And where do all of you fit in? It's the opportunities, kind of that meaningful, steady, legacy-defining work for both families and professionals. These 4 guideposts will frame our discussion today and highlight how skills, insight, and networks can accelerate the solutions. So why? Mission and urgency. So let's start with urgency. Hawaii's housing shortage is not abstract. It affects real families. Keiki without stable homes, kupuna displaced from their communities, and young adults leaving the islands because they cannot envision a future here. DHHL's wait list currently exceeds 29,000 people, and it grows about 600 per year. That's not just a statistics. It's 29,000 families waiting for stability, for connection, for the fulfillment of a promise made generations ago. Every year that passes without action is a year lost for a child's sense of home, a kupuna's chance to return to their land, a family's opportunity for security. Our mission is rooted in the Hawaiian Homes Commission Act of 1920. You know, Prince Kuhio, his intent, his hope was that all of Hawaiian people would have an opportunity to connect with the land. Unfortunately, when he was putting this before U.S. Congress, there was a party in Hawaii that was not happy with it and opposed it. And so U.S. Congress said, Prince Kuhio, I'm sorry, it's 50% blood quantum or nothing at all. And of course, he wasn't going to say nothing, so he went with the 50% quantum. Amazingly enough, there are many, thousands, hundreds of thousands of 50% still there. So it's an access to be able to accomplish and be able to reconnect our people with the Aina. It's a unique kuleana. Its responsibility is both legal and moral. It was an act that was created 100 years ago. The urgency isn't only about speed, it's about purpose and alignment. Delaying action has ripple effects. Every home not delivered increases pressure on rental markets. It stretches families thin and strains public housing systems. But every home delivered does more than serve the immediate beneficiary. It opens rental units for other families, eases pressure on affordable housing, and strengthens the broader housing ecosystem. How do we do this? Approach and partnerships. Partnership is our second guidepost. No single agency, firm, or profession can solve Hawaii's housing challenges alone. Collaboration is essential, and that includes you, developers, engineers, planners, and community stakeholders. Funding partnerships. You know, we look at the federal government and the shutdown, and some people can look at it as, okay, there's no movement, we can't do anything. Others are resilient. How do we continue to find opportunities that are out there? And so I share with you this, that housing starts with resources. One of the things that the department is doing is blending trust funds, state appropriations, federal grants, tax credits, private capital. Low-income housing tax credits, for example, are essential for creating affordable rentals. Private lenders help stretch public dollars. Every funding stream eventually becomes walls, roofs, and utilities. Your expertise in this market helps align financing with practical delivery timelines. Infrastructure is the foundation. Without roads, water, sewer, and electricity, homes remain plans on paper. The department invests heavily across Oahu, Maui, Hawaii, Island, and Kauai. Sequencing strategies, and don't forget Lanai. Sequencing strategies, shared agreements, and county partnerships help accelerate the process. For example, we have a memorandum of agreement and working relationship with the County of Maui. And they've put aside it's a portion of their GET set aside. It's accrued up to about $22 million so far. When the program sunsets in 2030, about 90 million would be contributed to this source of funding that we can be able to utilize, that we look together with the County of Maui and doing some kind of shared infrastructure so we can advance our projects and move them much more quickly. We're doing that on the island of Lanai. As you know, resources there are very limited. And so we're partnering with them on utilizing the emergency proclamation to be able to navigate our procurement process and contract directly the developer that they're using for their affordable housing project. The great thing is we're very familiar with this developer because we're using them in Kona. So what a great collaboration it is when we don't stop at when funding doesn't come in, but we be resilient to look at other places that partnerships can occur. We look at policy and process. Time is money in housing. Permitting delays, overlapping approvals, rigid codes can add years to projects. Streamlining processes isn't about cutting corners. It's about removing unnecessary friction. Your field insight as you and developers and those that invest into this space informs process reforms that actually work. Innovation in construction, modular units, prefabrication, panelization, new materials reduce cost and timelines. We're looking at a pilot project that will show about 15 to 20% savings. Innovation is mindset as much as method. Testing, learning, and scaling is how we expand opportunities across the islands. Preparing beneficiaries. DHHL is evolving how we deliver homesteads. Early project leases give beneficiaries a stake in development. It's a paper lease for a particular project, not tied to a particular lot. The financial assessments and literacy programs prepare families for ownership. So we go through a process. We award a project lease to someone that's on the wait list. They have something that they can hold on to. And the great thing about that is now that they're the only ones that have access to be able to receive an award. So now they can actually pass on that access to a 25% blood quantum successor. That sounds awesome, yeah? And so that now gives the successor an opportunity to have a chance to qualify for a house that's there. But we don't stop there. We're now looking at financial assessments, literacy programs to prepare families for home ownership. It really takes a village. Working with, I had a chance to talk with Suzanne on some of that home ownership prep program. We're working along with Hawaii Community Assets, working with Helen Y. Company that she has, getting our beneficiaries ready. What can they afford now? How do we place them into different areas? And what that does is it actually helps our developers be able to build homes that these beneficiaries can afford versus building a home and then trying to find if they can fit into it. So 4 pathways that we're looking at. We're providing options. Some of them can be able to go into a turnkey. Some may only qualify for self-help. Some may have the financial means to be able to do an owner build. As many of you know, that 20% down payment for construction loans, it's not easy. That's a lot of money. There was an auntie in Nanakuli. She had all the means, she could do it, but out of her pocket was $60,000 for that 20% down. Fortunately, she had it. Not everybody has it. They always see owner build as an option for them to try to build something that's really cheap, but it's so expensive. So we find other ways, a rent to own, utilizing that LIHTC financing, be able to work with them over a 15-year period, build that growth so they can financial wealth. So at the end of 15 years, they can be able to purchase a house that they can qualify for. And the great thing about it is they go into a brand new house. It's beautiful. They used a lot of money to build it. And they know exactly who was living in there before they bought it, right? Them. So they better take care of it. Results and impacts. Let me share this with you. Progress is measured in homes and in lives. Transform. DHHL delivers turnkey homes for families ready to move in. Kupuna housing for aging in place, subsistence agriculture, lots to reconnect Ohana with Aina, multifamily rentals for affordability and first families, financing and construction innovation. Lease-to-own structures, LIHTC projects, modular homes, and clustered utilities reduce cost and timelines. For every home delivered, stabilizes families, free rentals, and eases system pressures. For every dollar we spend on infrastructure, more than $6 is generated in private investment, and 3.6 jobs are created. I'm going to stop right here, and I shared with you about what we're doing. In this next 3 to 5 years, or actually, we told Governor next year. So he said, by end of next year, we're going to issue out 7,000 leases. We did about half of that this year. So we got a lot of work to do in this 2026. The amazing thing is, when we are given an appropriation of monies, for example, the $600 million back a couple of years ago, it unlocks additional financing that comes to the table. We're only building the infrastructure. We're not building the vertical. The developer comes with about $2 billion worth of developer financing to build the vertical so our beneficiaries can actually get into a house. We have about 7,000 that are going through that financial literacy engagement. And with that, we actually have about $1 billion of individual financing that's happening. These are the benefits of modular construction. We had gone through on making it more efficient, more affordable, quality, and jobs. One of the things that we are working on is it really takes a village. So it really takes collaboration with the unions and the trades and talking story with them about how do we make this happen, because we can't do this on our own. And sometimes we have what developers will call not enough on the bench. And so we have different islands that they have exhausted every union worker that's out there. So we got to find other ways of being creative and working with the unions, working with our workforce, working with our developers to make this happen. One of the things we looked at in looking at manufacturing housing or off-site construction is able to build it faster, lower construction costs, safer work environment, supports local jobs. So we're exploring options of doing something that's local to be able to cut down on some of the transportation costs, something that we can be able to mobilize within the different islands, because we have 29,000 beneficiaries. But along with us, we also have other agencies. I see Dean here, they're from HHFDC, and we have public housing. All of us are trying to fulfill affordable housing at the state level. And then as I look at Mike and Deborah and Mayor Blangiardi, trying to accomplish it at the city level, at the county level. What are our results? So sometimes you can't, we don't have enough money to purchase lands. And so we're looking at monetizing affordable housing credits. Right now across the state, we have about 2,300. So we're looking at utilizing it, working with private landowners on how do you monetize these affordable housing credits. We've worked with counties on being able to establish different revenue streams. We're also working with counties on establishing different land bases. We had a chance to chat with the City and County of Honolulu and identifying an area in Windward, Oahu. We had a conversation with the County of Hawaii in Kona. They have to build out a regional park that they've planned for many years, but it's on the hill. They're going through a number of different issues. But we have lands that are flat, that's close to the marina and so on. So we're doing a swap. They're going to give us the vistas. What a beautiful place to be able to build housing. And the great thing is Dean actually has some housing over there at HHFDC. We also have some housing that we've built from some of their land inventory. So it's adding another 1,000 more units to that particular area. We're also looking at we have this thing called Act 14. There is a resolution that needed to be resolved as far as lands coming back to the department. And so we're working with other state agencies to make that happen. Roughly about, I think we have 50,000 more acres. I could be wrong, it could be 500,000 more acres, but it's a lot. But we're working with different agencies to make that happen. And then also exchange of federal lands. There's lands that are out there that are sitting that we have resolved. There is an area that was the tsunami center out in Eva Beach. We did that exchange. We're working on building a huge community alongside the golf course. And I was like, wow, get Hawaiians on the golf course. Wonderful, huh? We also got Hawaiians in the Hawaii Kai Marina. We purchased the property from Kamehameha Schools, doing about 80 multifamily units, very consistent with the community around there on the marina. Got some Hawaiians out there. So where do you fit in? What are some of these opportunities that we have there? We have scattered lots all throughout. If we could turn the video off now. No, I'm just kidding. There's an area, and I'm going to say that's something that you guys might have explored before that we don't have in our inventory, that beneficiaries have it encumbered under a lease agreement, and they're looking to sell the property. That's kind of where you come in. I was a recipient of it. I was looking to upgrade. I wasn't on the list. My ex-wife was on the list. I had all of my paperwork. I just didn't turn it in. But we found a place that was newly built by Mark Development, about 5 years old, many years ago, and I was able to purchase that. Worked with my realtor, with our lender, was able to purchase that, and in the meantime, I had a townhouse somewhere else. But these are opportunities that are out there, not something that's in our current inventory, because when it comes under our current inventory, we're mandated by the Homestead Act to be able to address our wait list. So we need to go down that wait list and award the next property that comes up to them. So we are looking at places across the Pai'aina, or the state. We have all of these different lots that we're quickly moving forward on. And the interesting thing is when we award it, sometimes it sits, because as much as they think they can build a new house, they can't. It's very onerous. The process is tough. They don't know where to find financing. They don't know how to build the house, etc. So important that we partner up with service providers like Hawaii Community Lending, that now serves as this ambassador. So when we award it, with our agreement with Hawaii Community Lending, they walk them through the process. How much can this beneficiary afford? What type of loans can they be able to qualify for? Who is the general contractor that can be bonded and help them deliver a house that they can afford, and to a place that they can they walk with them all the way through until they can occupy the property. We can't do it by ourselves. It really takes a village. So as we close, remember that there are 4 guideposts. Urgency, the need is immediate. Partnership, no one can do this alone. It takes a village. Progress, every home ripples through the system. So the more that we address, the more that we take care of that, we're able to help the affordable housing initiative and the need for that. Opportunity, there's steady, meaningful, legacy-defining work that's out there that we continue to push forward on. Urgency, partnership, progress, opportunity. These aren't just words. They're the commitments that drive our work. They're the actions we must take to deliver homes for Hawaii's families. At the heart of this mission is returning land, stability, and opportunity to our Native Hawaiian beneficiaries. That is the kuleana we carry, the responsibility. It's one we cannot fulfill alone. It takes a village. This is where all of us that are in this room come in. Your expertise on the market, your connections to buyers, your ability to navigate challenges. These are the tools that turns plans into homes, blueprints into vibrant communities, urgency into tangible progress. So here's my call to action for you. Let's not just respond to Hawaii's housing challenges. Let's transform them together. Together we can create communities that honor our kupuna, sustain our keiki, and provide hope and opportunity for families who have waited far too long. Mahalo nui for your time and for the work you do every day in helping Hawaii families find their homes. With your partnership, we can shape the future of housing in our islands. Mahalo.
Your 2025 President, Mr. Trevor Ben.
Okay, thank you so much. Going before Lawrence, I told John Yamasato is like John Yamasato going before Bruno Mars. So I'm going to give you a market update, and we're going to talk a little bit about affordability and some other things. So let's get going. I only have 400 slides to get through. So what's happening in our market? Well, first of all, you guys all get this on the 6th of every month. You should know that we distribute the MSR the 6th of every month. For those of us who are not part of the Honolulu Board of Realtors and you want to get our data, we will put you on our mailing list. You'll get it the 6th of every month. So here's the big takeaway. We have a lot of nothing going on. So you see that line? It's just straight. The median 3 years ago, 1.1 million. The median today, 1.15 million. It's just flat, guys. But what's the devil's in the details? Let's take a look at, this is going back almost 40 years, 38 years of data. And what you're going to notice is that we don't appreciate in a linear manner. We go up a lot, and then we kind of level off, and we go up a lot, and then we level off. So the Japanese bubble in the 80s, we went up 122% in 5 years. And then we had really quite a bad period where we if you look at that chart, if you bought a house in 1990 for $400,000, you didn't break even until 2004. And the real problem is your mortgage was 10%. You couldn't refi because you didn't have equity. So guys who, 80% of our members got their license after 2000. They didn't get to live through that. So you guys got to remember, I don't want to see you on TikTok saying the real estate market never goes down. In the early 2000s, we had ninja loans, no income, you just got to breathe on a mirror and we'll give you a mortgage. And that caused 118% to go up in a short period of time. And then we sort of just had this steady thing. Yes, we had the credit crisis, but if you lived in Metro Honolulu, you weren't largely affected by that, let's say. If you were in some, maybe the Waikiki markets, et cetera, second home markets got hurt. But we were steadily climbing until what? Until COVID stimulus. And we go up 40% in a 2-year period of time. 2.5% mortgages plus quantitative easing will do that. And now we're living through our flat period, the doldrums. But some other things are happening. So this chart just shows you the inverse relationship between interest rates and pricing. So it gets a little wonky here at the end where we've got higher rates and higher prices. And that makes it really hard on affordability. And so here's the killer. Inventory. So months of inventory is always a weird statistic, but all it means is if no new inventory comes out, how long does it take to absorb the inventory that we already have? So you'll notice that condos have tripled from 3 years ago. We have 6.4 months. We peaked out in May at 7.1 months. But again, we have triple the amount of condos that we can normally absorb at a good pace. Houses is not as bad, so single family is doing pretty good. The lockup effect is wearing off. 31% of mortgages are sub 4%. And I'm laughing in my head because I stole this from you at the last NAR meeting. I just took a picture. Anyway, so you can't say it because I said it first, so now it's my stat. Life happens, things happen, people got to move on. So slowly those homes are selling. Although it's a pretty big disincentive not to move if you've got a 2.5% mortgage. This is just a visual showing you how during COVID with all that stimulus, demand and supply really did meet each other in a perfect, efficient market. And now we're starting to see a little bit of supply. It gets worse on this slide, obviously. Condos have some headwinds that we're going to talk about, where active inventory is far surpassing what we've been closing, which speaks to the inventory. So we slowly have a tale of two markets where condo and single family sort of moved in parity with each other, up and down. And now we're seeing this greater divide, especially during COVID, which Paul Brubaker says is because of remote work largely. I don't know that to be true or false, but it could be. And part of the issue that you're going to see is what I'm about to talk about on the next slide, which is that maintenance fees have risen 40% in the last decade. So that has a lot to do with the age of our inventory. We built a lot of condos in the 70s, and so you've got to change out the sewer lines, you've got to add fire suppression, and ultimately hurricane insurance was the killer for us this year. So I dealt with that a lot. For those of you who have been sleeping under a rock, Fannie Mae is requiring 100% hurricane coverage on buildings, which is kind of lunacy because there's never been one ever. Even Hurricane Otis in Acapulco blew out the glass. Actually, the superstructure holds up better. So you're asking to insure something that has never happened before, and you're not taking into account all the unique features of Hawaii, which is we generally go to 400 feet. We embed the building in calcified coral beds 65 feet under the ground, all these other factors. But the real kicker is there's only 3 licensed insurance companies in Hawaii. And after that, you got to go to the surplus lines, which is called the cowboy market for a reason, largely based out of Bermuda, which begs the question, would they be there if that event that's never happened before actually happened? But I digress. So 196 buildings now have special assessments, up 10% from last year, which was up 43% from the year before. Now, this statistic is probably likely over 200 buildings. Obviously, you can deal with your expenses through an increase in your maintenance fee, or you can do a special assessment. But if you guys, when you input your listings, don't check the box for special assessments, we can't catch it on this end. If you're just putting it in the agent remarks, which a lot of us do, then it just says, this much is the maintenance fee, this much is the assessment, then it doesn't tag here. So I'm going to venture to guess that the number is well over 200 buildings now in Hawaii have special assessments. And so Scott Psyche, I don't think is in the room, but I want to thank him by reenacting the Hawaii Hurricane Relief Fund. We've added some competition into the market so that we're driving hurricane coverage prices down. It's getting a little more reasonable for our condos, our AOAOs. And for those that couldn't get insurance at all, that's the solution for them. So it really has worked. It's not just lip service, it's actually bringing down prices. But we are still lobbying in Congress to actually try to roll back, and I'll talk about that. So we're going to talk for a second about the affordability challenge. Just so you know, the word housing and crisis, this came from Civil Beat. Housing and crisis, they pretty much appear together all the time. If somebody's talking about housing, they're adding the word crisis behind it. So let's dive into that. Is that factually based? I love this one. 1959, there was a huge upheaval because prices had gone up 21% in 4 years to a median of $19,500 for the median home. Where was my gungung then to buy me a house? Brada. He was raising ducks on what is now Ala Moana Shopping Center. That's a true story. Okay, 1969, same issue. 1970, they're pitching tents on Bachman Hall, protesting at UH. 1993, I'm saying this isn't a new thing, guys. 2005, I like this slide. He says it's a starter home. I like this because my friends say, Trevor, why do you work so hard? I say, one day I want to retire to the beach. They go, bro, you can go beach right now. You don't need to, right? So that's what this guy figured out. So how do we fix this issue that's been with us for so long? What are the factors that influence affordability? We have extreme scarcity since the Great Mahele, where private property ownership was created. Again, the only state with a monarchy. State and federal ownership is the largest landowners. I was happy to hear Deb say that there's considerations of utilizing some city lands. We want to have those conversations at the state level, the federal, every level. We have a huge swath of large landowners, which are the former monarchy lands, which are now either REITs or charitable trusts like KS, even Property Reserve, which is the LDS church, huge landowners. And then our topography, we just can't build on the Ko'olau and the Waianae mountain ranges are so steep. So what do you end up with? You end up with 4% of the land zoned for residential and 3/10 of the land zoned for multifamily. And we have the most restrictive land use regulations in the entire country. If you look back in 1959, they issued almost 9,000 residential permits, and 2 years ago it was 3,000. So what happened? We have extremely high construction costs, only going one direction. If you tariff the steel gets more expensive. That's a great question for our developers in the room. You have a set price on a condo that you agree to sell to somebody, but suddenly your costs go up. You have to absorb that. We have high demand, local and offshore. We have a changing in household size. I believe in the 70s, we had something like 3.9 humans per household, and we're down to like 3.3. Obviously, we don't want to live with each other. We got to get our own place. Low wages. This is the tragic truth of Hawaii. We pay our white-collar workers below our continent friends by probably 25 to 30%. We actually pay a premium for blue-collar work here, given our strong union and lack of a southern border delivering cheap labor. So that's the conundrum we're in. And then we have a lack of financial literacy in our education system. You would not believe how often, and I know all of you do this, don't buy the lifted Toyota, don't buy the gold chain, we're gonna save for your first house. That's the conversation we're gonna be having with all our clients, of course, and the end result is a net out-migration of Kama'aina, as Deb spoke to. So, what's the reality of it? Here's the 20-year appreciation rate for Hawaii real estate, 3.37%. Now, if I came to you and I said, Lawrence, I have this amazing investment opportunity. I'd like to make you 3.37%. Oh, and you got to pay property tax and maintain it. You would tell me, goodbye, get out of the room. I'm going to go buy a bond or something, right? So this idea that real estate in Hawaii has accelerated at this breakneck pace. I mean, our 40-year appreciation rate is basically 5%. This is your opportunity cost, by the way, is the stock market, which has been going at 10% a year, right? So what's the real problem? It's wage growth. We've been increasing wages at about 1.9% a year. That's why it feels like the train has left the station. You got inflation at 3%. Our real estate value is barely keeping up with inflation. So is it the high cost of real estate, or is it the low wages we're paying our people? And that's an economic issue. So courtesy of Yuhiro, we were doing okay until recently. The purple line is what we pay our people and what is required to get a loan to buy a house and a condo, blue being condo, house being yellow. And you'll see this huge divergence after COVID, where it became untenable because wages didn't keep up. So you've got massive inflation, you've got eggs costing more, you've got beef costing more, but we're not paying people more, so they feel like their dollar has been diminished, obviously. That's the definition of inflation. What's the housing supply needs? So we are undersupplied by about 64,000 units. So when I talk to people about how we're gonna solve it, this is the beginning and the end, guys. It's supply. We can try to alter demand all you want, but it's not gonna work. We gotta build. So how do we help? Regulatory costs are obviously the biggest thing. We're the third highest in the country. 58% of the cost to build a high-rise is regulatory. Entitlements, permitting, time costs money. It takes too long to do stuff. One thing that Yuhiro studied was the Centro. It's a building on Kapilani Boulevard, and it just speaks to the idea that the more inventory we provide, the more that gets released. So 512 units built, 130 sold to move into that. That's 640 plus units delivered to the market. The more you build, the more inventory you release. Let's look at advocacy efforts by the Honolulu Board of REALTORS. We just successfully had the mayor help us with this one. So I remember when I first got introduced to the problem, I said, when was residential A created? They said 2013. I said, I bet you the median back then was 660. They said, close, 650. How'd you get it so close? I said, because somebody in their wisdom said luxury begins at 150% of the median, which was 1 million, right? So they created Resi A. For those of you who don't know, 450 for the first million, like 1.1% after that. But the problem is the market appreciates it. When you don't index a number, eventually you meet the number. So the median today is 14% higher than what the city determines as luxury. So the average house in Hawaii is already Resi A. And then when you try to make a change, they give you the two worst words in the English language. Trevor, it has to be revenue neutral. I say, you created this tax from thin air, and now I must meet the income that it produces. And so we were successful in raising the tiers. It just got signed in. The problem is, so we're going to start Resi A at 1.3, and then there's a second tier that goes up to 3.5, and then a third tier. So I don't have the rates. That gets established later, but it kicks in 2027. So this is an ongoing battle forever, because in 2027 I'll be up. Well, I will not be up here. Christina Nishiyama might be up here, and she's going to tell you, well, you know, the median is 1.3 and Resi A starts at 1.3. So to all my politician friends, we have to index numbers, right? The only thing we index in Hawaii is the VA loan limits, right? We have the highest in the country. Take our median data. We'll give it to you. You want to have UHERO give it to you? That's fine. We have the data, right? So that's why, by the way, you guys inputting your information into our systems are so important, because the data produces policy. So what else are we talking about? What if values went up 40% in 2 years? What else went up 40% in 2 years? So city and county Honolulu property taxes prior to COVID, 1.265 billion, currently 1.77 billion. City and counties collected an additional $2 billion since COVID because our values went up. So we have to seriously talk about taxing measures, and when you come to us with a proposal about certain things, there better be a why as to what is this money needed for, because it should be the coffers are full. I don't know exactly, but we're going to have to determine how the city's needs are somehow related to the value of real estate. These two things are completely uncorrelated, and yet we have tied them together. Another thing is, when somebody says to you, Honolulu has the lowest property taxes in the country, we are the only municipality that doesn't include education expense in our property taxes. If you add the DOE budget into our property taxes, we are the 11th highest in the country. So we have to have honest conversations about data, okay? So when I go to DC, what am I fighting for? This. Our boomers never sellers. Some statistic I read, 61% say they'll never sell. NAR is picking up the mantle on this. We've been talking to our congressional leadership about it for a couple of years now. In 1997, Bill Clinton passed the Taxpayer Relief Act. Before that, if you remember, if you sold your house and you bought another house for at least $1 more, you didn't pay any tax. But people said, we want to downsize. So they said, fine, we'll give you $250,000 per person, $500,000 per married couple. If you've lived in it for 2 out of the last 5 years, John McCain added that for the military because they take 3-year tours. And that didn't work for Hawaii in 1997. It doesn't work 38 years later, or whatever that is, 28 years later. It certainly doesn't work. And how many of us go to a listing appointment and you say, oh, Trevor, I got to sell the house. Uncle trying to get on the ladder, clean the gutters, and he's 85 years old. We're going to move into the plaza, or we're going to go to Arcadia or something. You say, that's a good idea, but there's a problem, Auntie. You paid $50,000 for this house. It's worth $1.5 million. You're going to pay $300,000 in capital gains tax. Oh, yeah. And there's the kids are sitting down. I go, well, you could pay no tax, but you got to do something rather unsavory. Well, what we got to do? You got to make so that they get stepped up cost basis on this house. And then the kids suddenly go, oh, you know what, Dad, we can put on a ramp over here. And then we're going to cut a hole in the tub so you can get in and take a shower, sit down. And now what happens? What's the end result? The end result is we don't have that inventory for a young family to buy. And I'm telling them, you want to talk about revenue neutral, you're never going to get this money. It was always going to be stepped up. So let them sell the house. Raise that exemption or give us some sort of amnesty where we can sell these houses, release the inventory to young people, and get these people right-sized into the right kind of housing that's safe for our kupuna, right? Ray, they clapped for me. I just let my wife know they clapped. Okay, I'm almost done. So this is the forecast part. This is where I speak and not the Honolulu Board of Realtors, because we don't forecast at the Honolulu Board of Realtors. So what's happening out there? What are the trends we're seeing and where are we headed? So condos, obviously, as I expressed, have substantial headwinds. We have inventory problems which are slowing down our absorption rate. Maintenance fees have jumped, as I spoke about. And we also have to fight a strong dollar internationally. So the Japanese are not just not buying, they are actively selling. So if you're competing in a building to sell and your other unit competing against you is a Japanese seller, I mean, he's going to make 50% just repatriating the yen, right? So I just had a deal at IO maybe a year ago where my client's like, oh, we got a really good deal. We paid $800. The guy paid $1 million. I go, yeah, he did good too. What do you mean? He lost 200 grand? No. He's going to make 50% on the 800 because he bought it at 95 yen to the dollar. He's going to trade it back at 150 yen to the dollar. So that is also expressed in what Deb's talking about tourism, right? So when we have such a strong dollar, they're not coming, and we need that economic engine. We're going to see more regulation and taxation proposals to alter demand, and I implore the politicians in the room that that is not how you solve housing. If you stop external dollars from coming into our state, you're just hurting the economy. And they don't buy the same stuff we buy, right? They typically, I mean, if you're trying to reduce outside investors in Waikiki and Kaka'ako, then you better have locals to pick up the slack, which has not shown itself necessarily. Although, frankly, Kaka'ako is largely locals, so you should know the statistics. They're talking about conveyance tax increases. They're talking about deed restrictions. Empty homes tax, I go to bed at night. They never let it die. I got to fight empty home tax for the rest of my life. Okay. We got to encourage our leaders to focus on supply. We want to help, all right? These entitlements, and I'm laughing because Christine Camp is here, and she'll tell you that the last thing she worked on at Castle and Cook was Core Ridge. That's 25 years ago. And the problem with that is when Harry Saunders promised us Core Ridge, it was $300,000 a house. And then they finally build it 25 years later, it's $1.2 million. It cannot take 25 years. Here's the kicker. David Murdoch and Harry, rest their souls, are not even with us anymore. They couldn't outlast DPP. So it can't take this long, guys. And I want to thank the mayor who got up on, and he's like, I'm going to fix this damn thing. And I thank him. Thank you. We got to fix it. It's the economic engine of Hawaii. And I want to say right now, we are the largest trade organization on Oahu. With HAR, we're the largest trade organization in the state. With NAR, we're the largest trade organization in the United States. If you're having conversations about housing, dear God, put the realtors in the room. We put more people in houses than anybody, right? And I say the same to our developer friends. Are you really building this thing and you're going to hand us the keys and tell us to sell it and you didn't give us any input on what you're building? I find that interesting. What are we fighting for in DC? I talked about higher exemptions. We want Fannie to roll back the hurricane requirements. That's crushing it because condos are the first rung on the housing ladder. We got to get guys into that ladder, climbing the ladder to financial security so they can stay here. And the state's going to have to understand that they may have to give up lands and not make money to keep the taxpayer in the state because that's a bigger benefit. And when the city comes out and says, we're going to give you all of these entitlements to build this at more density, higher FAR, blah, 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 they make their money back almost instantly. You take a piece of industrial land in Kaka'ako that used to be valued at $15 million, you put 500 units on it, and now it's worth $500 million. You know what the tax base does for that piece of dirt, right? So work with us. And I told my daughter, hey, you want one of these units? Because crazy thing, it doesn't preclude gifting. I can buy you one. I'm testing her, right? Man, go there, read the paper. No, Dad, how long is it going to take to build? Oh, 3 to 4 years. Wait, and I got to live in it for 10 years? I go, yeah. Wait, I'll be 35 years old living in this studio in Kaka'ako? Oh, yeah. She goes, yeah, I pass, right? So we got to build stuff that makes sense, guys. what's happening out there? You guys all know this. What killed office? We're at 12%, 13% vacancy in Hawaii. I always look at San Francisco. San Francisco's at 28%. I was talking to a friend in Bend, Oregon yesterday. They had 33% vacancy. Starbucks killed the office. Well, they started to kill the office, building 35,000 remote offices without trying. Then came Zoom, and office is really been hurt, and we're hoping it can come back. We're hoping we get people back in the offices. People like Christine are going to repurpose some of these spaces and really build a vibrant downtown again, which I appreciate. What's killing retail? I don't know. Come to my house any day of the week and see the boxes that have the smiley face on it, right? So there's Amazon is crushing it. They just had earnings today. The stock's going crazy. Meanwhile, your mom and pop retailer is getting crushed. Every mall in America is turning into a residential amenity. You might live at Ala Moana Shopping Center or Kahala Mall or something. That might be your future. And then we're going to go downstairs and meet at Gomate and eat. And so retail is changing constantly. Industrial went from the bottom to the top, right? They get rid of all the industrial in the urban core and they push them out to the outskirts. And now anything closer to your urban core is the most valuable industrial in Hawaii, right? So if somebody says, what should I have bought 10 years ago? Kapalama, like Kalihi Street, Home Rule, Democrat, you'd make a fortune because if you own a plumbing company, you don't want to be 2 hours away from your customers. What's the hottest amenity in condos? You guys have heard me talk about this. It's a dining room. Who would have thought that a dining room would be the hottest amenity, but you can't even, book it at your thing. Why? Because the developer can now deliver you a smaller and smaller, more efficient unit because you're never going to entertain in that space. You're going to meet your friends on the 6th floor in that beautiful dining room and eat there. Because if I said, hey, Lance, I'm coming to your house tomorrow for dinner, you'd be like, hey, I gotta clean up, bro. Maybe next week. So instead, we just go to and so that begs the question, how much community living, how much communal shared experiences are we willing to have? What's development look like in the future, right? Because condos were always a shared expense for the amenities. Hey, I can't afford my own pool, but can I afford 1/500th of a pool? Sure. So how much more of that is going to happen? Can I do with one shower in this condo instead of two? We'll see what happens. Waymo, I rode one in San Francisco. It was the best ride I had. It was autonomous. So that's definitely happening. And that's the game changer for real estate. Is it? Do we need an urban core if I can live anywhere I want because I can be wherever I want? No DUIs, no speeding tickets. Pretty killer, right? And so that's part of the multi-tiered TOD rail thing that we're going to do. I'm going to leave it there. Although, funny story, I was in San Francisco and the Waymo stopped and 9 cars backed up and they're all honking their horns. And I'm like, why is this Waymo stopped? And there was a seagull in the road. And right by Boudin's where you get the bread bowl, clam chowder, it couldn't move. So I took up my phone and I'm like, this is hilarious. So a human would just go slow and the bird would move, but the Waymo just didn't know what to do. So, and I was enjoying it, so I let the bird stay there. AI, it's all anybody wants to talk about and absolutely going to be changing our industry. It's going to change everything, guys. And so whatever you think is going to happen, it's going to happen 5 times faster. So we got to be prepared and we got to have way better data. So you're going to see some initiatives from us about improving our data. And that's the data we're not going to give away. Okay? So we're all on the same team. All right. That's it for me. Thanks so much. All right. Sorry, I got to have the paper. All right. Now, for the main event. I want to introduce Dr. Lauren Yun, the chief economist, and he oversees the research group at the National Association of REALTORS. He supervises and is responsible for a wide range of research activities for the association, including NAR's existing home sales statistics, affordability index, and the home buyers and sellers profile report. Dr. Yun creates NAR's forecasts and participates in many economic forecasting panels, among them the Blue Chip Council and the Wall Street Journal Forecasting Survey. He also participates in the Industrial Economist discussion group at the Joint Center for Housing Studies at Harvard. He appears regularly on financial news outlets and is a frequent speaker at the real estate conferences throughout the United States and has testified before Congress. Dr. Yoon has also appeared as a guest on C-SPAN's Washington Journal. In 2025, the Wall Street Journal congratulated him for having one of the closest forecasts in 2024. Please welcome from Washington, D.C., Dr. Lawrence Yoon.
Good morning, everyone. Good morning, everyone. So I am feeling very uncomfortable because when I speak, I am always in suit and tie. But at the instruction of Suzanne and Trevor, I want to be the local person along with you. So very great to be here. And of course, who could not reject the invitation from Honolulu? And I was in different islands. The president of Hawaii Association, Lance, and I were in the Big Island yesterday for the presentation. But thank you very much. Trevor, Lance, they come to Washington, as mentioned, one of the important issues they are representing for your interests, along with other 8,000 realtors who came to Washington. And members of Congress, congressional staff, know it is a realtor day because there will be realtors walking down the halls of Congress, talking with their elected officials, and the top issue that we were discussing was about the capital gains exemption. You sell the home, and the spirit of the law, when it was done 30 years ago, was to say the money is yours. You get to do what you want to do with that money. But given what has happened with home prices, inflationary pressures, many people are needing to pay that tax, and consequently, they are changing their mind about whether to sell or not. So very important issue that we are still working on that regarding that. But let me just go into what you can anticipate regarding the real estate market condition, because all the data is showing that it's been a tough 3 years. Tough for realtors, tough for people in the title insurance, mortgage originators, or even people who do moving truck business, because people are not moving, people are not selling their home in the past 3 years. And one of the key reasons is because of the elevated increase in mortgage rate that you see. Red line is what you care about, what your clients care about, the mortgage rate. And it went up from 3% all the way to 8%, then 7% condition, and essentially flipped the housing market condition. So high mortgage rate really flipped the market, buyers disappear. But what's most unique about this housing cycle is that when the mortgage rate increase, sellers disappear, the lock-in effect. So what do you do as a realtor when you don't have a buyer and you don't have a seller? Very, very tough condition. So the blue line is the Federal Reserve policy. Federal Reserve cut interest rate this week. On the day of the rate cut, mortgage rate increase. And don't be surprised about that, because there's never a one-to-one relationship, or people, your clients are saying that, well, the next meeting is in December, maybe I should wait until the December meeting before I consider getting a mortgage. Well, it could backfire. Trying to market time can always backfire. But nonetheless, what the graph shows is that over a longer time span, two lines directionally move together. So when the Federal Reserve had a zero interest rate policy during the early years of COVID, mortgage rate historically low. But when the Federal Reserve aggressively, most aggressive interest rate hike policy in 2 generations, we have never seen anything like that since the early 1980s, which means that many young people, you have never seen such an aggressive interest rate hiking policy that boosted the mortgage rate condition. But the good news is that we have already had 2 rate cuts, and consequently, even though it is not a one-to-one relationship, mortgage rates today are at near one-year low levels. So again, directionally, over a longer time span, it moves similarly, and there's an expectation that there will be another rate cut by the Federal Reserve. One interesting part is that early part of this year, there was a huge debate in Washington between the White House and what was considered to be independent central bank, the Federal Reserve. So generally speaking, the White House would respect what Federal Reserve does, just do your job. That would be the part. Well, President Trump is not unlike other presidents. President Trump has been using his own language regarding the Federal Reserve, essentially saying that Federal Reserve are a bunch of idiots. They don't know how to do the economy. Federal Reserve should have cut interest rate long time ago and deeply. Federal Reserve said, no, we cannot cut interest rate because inflation is not under control. We want to make sure that the dollar has a purchasing power. And when the inflation rate was near 10% 3 summers ago, you remember, you went to the grocery store, you came out super angry. What the heck happened? You went to the gas station, you were angry. So we want to make sure that the dollar is a dollar, and that is actually a charter, a mandate of the Federal Reserve, and that's why the Federal Reserve aggressively raised interest rate, because in a sense, they were behind the curve. Why did the inflation happen? Well, inflation happened, they were trying to catch up, so they wanted to bring the inflation rate back to normal. Normal inflation would be 2% or below. We are not there yet. But the Federal Reserve cut interest rate in September, and they did it again this week. Are the Federal Reserve finally caving to the White House pressure? And the answer is no. Something else has happened to the economy recently. And before doing that, the Wall Street expectation right now is for another rate cut in December. The red bar is the most recent in the predictions market, where people are betting money how many rate cut by the Federal Reserve. So Federal Reserve already did 2, but the expectation is for 3. Next meeting is in December, which means that there will likely be another rate cut in December. So what has changed as to why the Federal Reserve cut interest rate is that the labor market has changed. Labor market appears to be softening, likely to be softening. We don't know for sure because we don't have data. We are in a government shutdown, but all the indications are saying that, well, some companies are announcing layoffs condition. So now the focus of the Federal Reserve is away from inflation and to the labor market. They are saying, let's try to help the labor market. We need to have job creation. But when you cut interest rate at a time when inflation is not fully under control, some people are concerned that we may have permanently high inflation. And if that is the case, you want to have inflation hedge. All through human history, you find that when there is a hyperinflation, as happened, say, when the Soviet Union broke down, say somebody living in Russia, somebody living in Ukraine, somebody living in, say, a country, Georgia, a former Soviet republic, they saved up money to buy a car. Well, overnight, that money became worthless. You could not buy anything with it. But if you had gold, then you could buy something. So as an inflation hedge, people want to have things like gold. So gold prices have really jumped up, partly because people are saying, well, if the Federal Reserve is going to cut interest rate when inflation is not under control, maybe we will have permanently higher inflation. Now, this is not a hyperinflation, but still 3%, 4% inflation will be uncomfortable compared to 1 or 2% inflation. I show this chart not only in terms of your personal finance or what's happening in the thing, but to counter-argue some of the sentiment that may be out there to say home prices in Hawaii, home prices across the United States have risen so much in recent years, surely it's going to return back to normal, meaning that it's going to crash. So home prices went up, say 40%, maybe it will decline 40%. So some people are saying, no, I'm going to wait until home prices crash before going into the market. Show this chart. Why? Because aside from gold, another hard asset has always provided a strong purchasing power in the period of high inflation, hyperinflation, real estate. So the fact that gold prices have went up, I'm not trying to say that real estate prices will go like this, but at least you can make the argument that real estate has served as an inflation hedge. So surely to think that there will be a price crash, that is a wrong way to view it. So this is one part of it. So now let me go back to the labor market condition. So the Federal Reserve has cut interest rate, because they are saying that the labor market is softening. So let's look at it. How many Americans are receiving steady income paycheck? W-2 statement paycheck. Realtors, your income is on commission, so you are not actually included in this data. But among, say, people, teachers, people working in offices, receiving steady income, how many people are receiving paycheck? Right before COVID is the beginning. Then we had a COVID lockdown, so all the hotels had to shut down, restaurants had to lay off people. But once the economy reopened, more jobs, such that in the most recently available, which is actually August, I mislabeled it here, August, we're in a government shutdown, we don't have September data. We have 7.2 million record high employment, all-time high. So where is the weakness in the labor market? Let me put the same data slightly differently. Rather than total number of people receiving paycheck, how many new people are getting jobs? And this is the figure. So as you can see, recently, the job numbers are weak, soft, and we don't want to see it in a negative territory consistently prolonged, which means economic recession condition. So job market is weak, and that's why the Federal Reserve is cutting interest rate in order to help revive the job market condition. Now, one of the reasons as to why the job numbers are softer is actually purposeful. Here's the number of people working for the federal government. The peak is January 2020. Then you see the decline. Why the decline? Because Elon Musk came to Washington. And his job was to slash away at wasteful government spending. So slash it away. 100,000 fewer people working for the federal government. I'm from the DC, and I can clearly see much more visibly compared to other states. And I know that other states also have federal government employees. Now, some of it could be completely wasteful government spending, and we would be all supportive of cutting the fat. But how much of it is now the meat and the muscles and the bones to it, because we are hearing that maybe air traffic controller or say medical research, which the payoff may not be until say 10 years or 20 years from now, could impact. But one wonders. But this number will continue to show decline because this is people who got fired. There's equal number of people who took early retirement, and their last paycheck was at the September 30th. So now they will begin to show up on the October figure, November figures, and so forth. So one reason for the weakness in the job number is because federal government job numbers are much softer now than before. But we see it in the news as well. The private companies are also slashing jobs. So it's not only the federal government weakness, but the private sector are also showing a little bit of softness. But among the people who have jobs across America, and it was interesting to see Trevor's slide where the wage growth in Hawaii has been sort of much softer compared to the rest of the country. But across America, the wage growth shown in red, inflation in the blue is indicating that at least among the people who have jobs, their standard of living is modestly improving. Beginning of the chart, again, 3 summers ago, grocery bill being very high. Well, it was justifiable as to why Americans were angry. Their standard of living was falling. Their wage growth simply could not keep up with the inflation rate condition. But right now, among the average American with job, their standard of living modestly improving. Not all states are equal in terms of jobs. So this shows a little variation. Green color states are the superstars. Number 1 in the country, state of Idaho, 14% more job today compared to pre-COVID highs. I'm comparing with the pre-COVID high levels, 14% more job. Dark blue, when the essence would be above national average, while the light blue is positive but a little sluggish, a little slow. Hawaii has a unique color. It is the only state in the country negative. You have fewer jobs today compared to pre-COVID condition. So you wonder what it is. Now, I wish I had put another United States map on this chart, which I did not put, because I know you would feel a little depressed now. If I put the life expectancy, where it has the highest life expectancy, Hawaii will be number one. So if you really care about life, Hawaiians are enjoying the life. But the job number is showing negative. And let me actually show you graphically over a timeline. So this is from year 2000 to the most recent. So little fluctuation. The big decline that you see is the COVID lockdown. Now, in hindsight, with anything, in hindsight, it's a clear vision. But during that moment, it's very unclear, which is COVID cannot be spread at outdoors. Hawaii, you have lovely outdoors, COVID would not spread, but for some reason, Hawaii had one of the most strictest, longest lockdown. And consequently, you see the huge dip in the employment condition. And you have not fully come out of that yet. So still little below pre-COVID, only state in the country where it is still below COVID condition. Honolulu, again, showing condition, but I also show that it's 70,000 job creation over a 25-year period. And that's the reference point just to illustrate that at least over the long term, there's still job addition. But if you can look at the home sales are below what it was in the year 2000. So you are saying, well, if we have more job, why is the home sales much lower? Let's discuss things like affordability challenges in place, or the conditions are not right. High mortgage rate, a lack of inventory contributing it. So if the mortgage rate somehow was to get a little lower, more inventory show up, more supply, maybe you can really get the housing market going, because you can view the job number over a longer time span as potential pent-up housing demand that could be released into the market if the condition turn for the better. Lower mortgage rate, more inventory, more supply coming onto the market. And this is just other states, just for reference. Somehow Maui is underperforming among the islands. And some of the Maui realtors were actually explaining to me what could be some of the reasons. It's not only the wildfire. I thought it was the wildfire, but they are saying there are other issues in Maui that's holding back part. And this is the state level. I show a very long graph just to show you that back in 1960, there were only 200,000 people with jobs. Today, it is closer to 650,000, which also means for people or your ancestry, if they were here in the 1960s, you should have told them you should have bought more property back then, because certainly with the growth that occurred, it means that there's always rising housing demand. Now, this graph is very, very interesting. I mentioned that the Hawaii job market is the last in the country, yet the unemployment rate is very, very low. It may be one of the lowest in the country. The peak is the COVID lockdown, but currently it's very low. You still see stuff help want to sign, it's a service job and so forth, but still you see some help want to sign. So why is it that there is help wanted sign, but no job creation? This is how, the way I interpret it is, some people are saying, look, it's not worth finding a job in Hawaii. You find a job, service industry job, and what do? All your money go for rent, and there's nothing left over. I'd rather go to Nevada, I'd rather go to Arizona and find a job there, so at least my standard of living will be a little better position. So housing crisis may be the reason why the job numbers are very, very weak. When I hear a story, a native Hawaiian where their ancestry has lived on the island for 500 years or more, unable to live today here in Hawaii, and now they have to move to Nevada, that just boggles my mind. How is that possible? So I'm very happy to hear from the Department of the Homeland in Hawaiian explaining the situation, trying to bring more Native Hawaiian back to the island, have the special resources available, because it just does not make sense as you think about how is it that Native Hawaiians cannot live on the island and they have to move elsewhere. So to have reversal of that process, I'm glad to hear the early speaker on the topic. Quickly on the commercial real estate. So this is a very scary chart. If economists went to a Halloween party, they would dress up like this. This is the number of commercial real estate loans that has to be refinanced. Unlike residential loans, commercial real estate loans are for short duration, 3 years, 5 years, and you have to refinance. When do people get the loan? When the interest rates were 3%. To buy office building, to buy apartment buildings, they got at 3%, but now they need to refinance. 7% mortgage rate? No, that's not gonna work. So people are beginning to scream to say the numbers cannot work. In addition, the collateral value has collapsed. So the price of the apartment building, if you wanted to sell, or price of the office building, if you wanted to sell today, is lower. So the banks are saying, look, you have to pay me higher interest, and also, by the way, you have to come up with additional $200,000 to make up for the decline in the collateral value, making it very, very difficult for the commercial real estate condition. And furthermore, if you look at which banks are exposed to the commercial real estate loan, it is the red. Your local banks, like Hawaii, Bank of Hawaii, and many other local banks out there. The greens are the name recognition banks, JP Morgan, Bank of America, Wells Fargo. So it's not the large bank who have the commercial real estate loan in their portfolio, it is your local regional banks. So if there is a banking crisis, it would be from the local regional bank. And the Federal Reserve is aware of this, and I think this is another motivation for the Federal Reserve to cut interest rate in December, do more rounds of rate cut throughout next year, because they need to avoid that massive refinancing headache in the commercial real estate loan, because refinancing is much easier if the interest rates are lower. And the commercial real estate loans will be more tied to that short-term interest rate. Now let's go to the residential real estate. This is a nationwide statistics. Trevor went over many of the local market statistics, so please go to the either State Association website or the local Honolulu Board of REALTORS website, and there's all this detailed information, and you are peruse through it. But the bottom line is, number of home sales in the past 3 years has been very, very difficult. So 2019 is the first bar. You can view that as a reference point, because 2018, 2017, 5 years prior to 2019, sales would have been very similar to that. So 2019 as a reference, normal. Then we had a 2 years of frenzy, low interest rate, multiple offer situation. Then when the Federal Reserve raised interest rate, sales coming down, such that in the past 3 years, very, very difficult condition. I'm actually surprised that the realtors are still being resilient according to the numbers. And I think one possibility could be that even though the commission income is not there, from our survey, about 40% of the realtors have investment properties. So at least investment property prices went up, so at least maybe that is a little comforting, compensating factor. But the commission income has been very difficult. While the builders are actually back up to pre-COVID, because builders can do something that realtors cannot do. Realtors, you are waiting for your past client to list their property. And your past clients, 3% mortgage rate, I will never list my property again. I'm gonna keep this 3%. While the builders can simply create inventory. By creating inventory, they can do the sales. So that's why they're back up to pre-COVID. When your past clients, which you met with, say 1 year ago, 2 years ago, and they said they would never list their property, they're expressing their sincere sentiment. So they're saying, no, I don't want to do it. But when you look at the actual data, some people are beginning to change their mind. We are beginning to see more inventory show up. So why is it that the lock-in effect is less strong now than before? Because with passage of time, stuff happens. Marriages, divorces, death in the family, additional child. Maybe the elementary school was fine, but for middle school, you are considering changing residence. What about new job at different location? All this thing eventually lead to some people needing to give up their low interest rate and look for a new home. So more inventory is beginning to show up for the realtors. So Honolulu data, I'm not going to go over because Trevor went over many data, but it shows very similar to the national trend. 2025, I did not put, but It looks to be similar, and again, you can go into the detail from the highcentral.com to get all the local market information. Here's a business information. What the realtors are doing across the country, maybe it doesn't truly reflect the neighborhood that you serve, but I think you can still use this information. For some home sellers who are saying, my home is golden, well, it's worth a lot. And you know, according to the market, it's not. So longer the days on the market, there's a larger price cut. We know that, but what I'm finding, what the realtors are actually doing across the country is these figures. Now the middle column is pending contract. When you get a pending contract, especially for the first-year agent, don't celebrate. It's not closing yet. So if you go from the middle column to the final column, you see a larger price reduction because home inspection issues and all the other part. So if you look at the final column, essentially saying that if home is staying on the market for more than 3 months, you are doing 10.5% price cut. While if you are doing 120 days or more, 13.5%. So if you misprice the home from the beginning, it may actually backfire. You have to price according to the market condition. So maybe this could be used to sort of talk to your sellers who think that home is worth much more than what the market can bear. Now, as related to the prices, whole country has seen a strong price increase. I sort of mislabeled on the headline. I was in Massachusetts, so it was 56% price growth in Massachusetts. Hawaii is showing 47% price growth. So however you want to look at it, 56%, 47%, all states across the country has seen huge price gains. Number one in the country, state of Maine, 80% price gain. What's happening in Maine, aside from ability to eat lobster? Not much. Other than the fact that they are saying that many people from Boston and New York City during COVID remote work went to Maine and purchased property. So one wonders, Hawaii, the economy, tourism. Then you have in the island, pineapples, other agricultural products. But it could also become more high-income job addition. For example, Miami is trying to attract many of the Wall Street companies to come down because with computer technology, internet access, all the work pretty much could be done in any city. With a huge AI boom that's occurring in the Northern California, all the direct flight from Honolulu to the mainland appears to be mostly from California. Can you begin to draw some of the AI companies to be located here? Because people can work. As long as there's a computer, people can pretty much work anywhere. So something to just consider because you look at Maine benefited because they had a clean air, ocean view. Well, Hawaii, you have much, much more in terms of the natural beauty in that regard. Home price appreciation over time, mostly positive. Only time it was negative was after those ninja loans. You gave the mortgage to people who couldn't even pay back. Well, we suffered through that, but right now the price is still holding on. And then I think Trevor showed this chart. And consequently, the real estate across the country, all-time high. Stock market wealth essentially at near all-time high as well, but also worth emphasizing that real estate wealth is all-time high at near $40 trillion. Now, anytime you go into the $1 trillion, it's hard to put our fingers around it. So let me put it per person. Typical homeowners versus typical renters. Intuitively, we know, maybe you have seen it, but worth re-emphasizing. Homeowners build wealth over time. Renters are simply spinning their wheels. They are not accumulating wealth. We know that, but the data also confirms that. And since the data is from the Federal Reserve, maybe you want to share it with some potential home buyers out there. They're not trying to time the market. They're just saying, I want to own Piece of America because by owning Piece of America, you build wealth over time. You can always refinance at some point. So a huge, staggering difference. This is a national statistics. If there was one specifically for Hawaii, it would be even greater disparity between owners and renters. And here's the home ownership rate. Blue is the nation, Red is Hawaii. The data sample is smaller at a state level, so it bounces a bit, but it's showing lower home ownership rate. So when you look at the wealth disparity, you are saying that wealth disparity is much, much greater in Hawaii compared to other states, and consequently, giving that more opportunity for home ownership, that will be the key in terms of trying to make the state economy, family financial condition much, much better. And for sake of time, let me go to my final two or three slides. I discussed that home prices have been stable, very little change, but again, there's some sentiment out there where consumers are saying there could be a price crash. Show the gold prices, that's one thing to show, but this is another chart to show as to why price crash simply cannot occur. Mortgage delinquency of more than 3 straight months, serious delinquency, in the yellow, historically low. You saw a huge pickup during COVID, because during COVID, they said, if you cannot pay mortgage, don't worry about it, don't pay mortgage. We're gonna simply add on to your next end of the term part. So many people did not pay mortgage during that time, but there was no foreclosure because government allowed people not to pay mortgages. But once people found jobs, they start paying mortgages. Also, NAR worked on the rental subsidy because you cannot evict people during COVID, and some people don't have income to pay rent, but the landlords, housing providers should not suffer from that. So we pushed for rental subsidies so that landlord could be made whole during the COVID. So I hope many of you took advantage of that. Different states had different administrative issues. In California, the rental subsidy, they cut the check to the tenant. And many of the tenants never paid the rent. And California had a law you cannot evict. Well, a very difficult condition part. But the bottom line, foreclosure rate, mortgage delinquency, historically low, we will not have home price crash. Or if there is a price decline, view it as temporary and a second chance opportunity to pick that up. So because conditions are saying gold prices, mortgage delinquency, all at a healthy condition. So little light flashing at the end of the tunnel. Some people are saying, oh, that could be a train coming through the tunnel, you will just wipe you away. But I think this is saying that this is truly a positive light. Mortgage applications have been consistently above last year's levels. Mortgage application is not mortgage approval. Some are mortgage approval, but it could be mortgage denial. Other people who got mortgage approval simply cannot find the right inventory, so they never purchased a home. But what this chart shows is the serious intent, not a casual browsing of the web, but a serious intent of wanting to buy. With lower mortgage rate anticipated, more people will qualify, get approval. So, and we are beginning to see more inventory condition. So again, conditions are moving in the right direction, and consequently, my last slide is that this year, 2025, is a bummer. Maybe the fourth quarter will be a little better than fourth quarter of last year. We squeak out some small gain in terms of the unit sales, nationwide forecast. But the big increase is really next year, because condition will be much better. More inventory, lower mortgage rates, more people qualifying, so much bigger meaningful boost of 14% in this table. The reality will not be 14%. The reality may be 10% growth or 20% growth. We have to wait and see, but the model is clearly, the logic is clearly suggesting it's gonna be a meaningful growth next year. No price decline. I think there will be consistent price increase, small amount, but the key is mortgage rates sort of settling down at 6% average. So maybe 5.5, maybe 6.5, sort of bouncing along this level for most of next year. And we hope that we avoid economic recession, so we still have some positive job addition. So with this, I wish you the best in your business opportunity in the upcoming year. I know it's been very difficult the past 3 years, and certainly your leadership, Trevor, Lance, and others who come to Washington, advocate on behalf of all the realtors representing in Hawaii, it certainly makes a difference. So thank you very much.
Thank you, Lawrence. So now I know we're running a little over time. We're just going to ask a few questions on a Q&A with Lawrence. Here, Fran, choose a question. Fran, choose a question. You can go first. We welcome Fran Gendrano to the stage.
So nice to be here. So nice to have Lawrence. Thank you so much. Also, Trevor for governor or Trevor for mayor, perhaps? I don't know about you, but I've learned a lot today. It's been wonderful. But we had some pre-prepared questions that we'd like to kind of float by you, and we'd love to hear what you have to say. In a market appreciating at 4 to 5% annually, but with interest rates above that, how can Hawaii-based buyers and owners build wealth?
So the chart clearly shows the result of the ownership and the wealth building. Even if it's 4%, given that the median home price is $1 million, 4%, that is a $40,000 in equity gain in a single year. But you never know when the prices could make an upward swing suddenly, 20% gain, and you never want to miss out on those opportunity. I forgot to mention one unique aspect about the Hawaii market. Condominium sales are almost equal weight as the single family. This is very unique. You don't see it in Ohio where 95% of transactions are single family. So anytime there's a condominium issues, certainly it has more impact. And Trevor discussed many of the condominium market issues. So right now, condo prices may be falling with increased supply situation. So maybe this is again second chance opportunity to get in. But even the 4%, consistent 4%, that will be a very good wealth gain.
Okay. On November 5th, the Supreme Court will address challenges to the president's power to impose tariffs. We have some developers in the room. How are the tariffs impacting housing costs now and in the future?
Pulte Home Builder. I bring Pulte because Mr. Pulte is working with President Trump near the White House. He's the overseer of the Fannie Mae, Freddie Mac condition. And he wants to see lower interest rate. He wants to see more people buying home condition. So Pulte Company, not the Pulte, the person, company came out with a report that tariff will increase the building cost by roughly $20,000. Now, they have begun to readjust that figure to say it's not going to be $20,000, but it's maybe a $10,000 additional. Steel cost, the lumber cost being much more expensive now than before. But without a doubt, tariff will increase the cost of home construction. But your chart shows huge regulatory costs, which is not related to the tariff part, but anything to just chip away at some of the cost element of it. I think many of the people in the academia who are beginning to study housing affordability issue, the modular housing may be one big way to make a huge dent in lowering the cost part. But tariff, certainly a very negative, but we have to await the Supreme Court decision. But so far, executive decision from the White House is saying tariff here, tariff there. But sometimes President Trump is lowering the tariff after the negotiation. So we have to wait and see. Yeah.
So to that point, if the replacement cost goes up for new construction, does existing inventory?
It's from consumers' perspective, existing home, new home, is just looking for their right home. But to the degree that the new home is more costly, it makes existing home a little more attractive in that regard.
Yeah. Okay. Well, we're running out of time, so as I noted in our opening, our goal today was to share data, provide context, and have a conversation about the opportunities and challenges that exist in Hawaii's real estate market. I want to thank Deb Zeisman from the city, Kalani Franda from DHHL, and Dr. Lawrence June from NAR for helping us achieve our goal today. We hope you found the information helps you advance the conversation about how together business leaders and policymakers and our realtors, who are housing experts, can help shape solutions to keep more of our local families here in Hawaii. Mahalo to each and every one of you for taking the time today. Thank you so much.